Few big economic stories to get into with our next guests, including Friday's much hotter than expected jobs report and some new debt projections on the presidential candidate's economic plans. Join us right now, former Council of Economic Advisors Chairman Jason Furman. He's a professor at Harvard's Kennedy School of Government, and former Congressional Budget Office Director Douglas Holtz-Eakin. He's president of the American Action Forum. I was actually going to say, did you see the Marco Rubio tweets over the weekend claiming that these that somehow these jobs numbers were sort of artificially inflated? Jason, I was curious what you thought of those numbers themselves and maybe what some of those accusations.
It's just sad when people respond to the jobs numbers that way. It's obviously incredibly nonpartisan, upfront people doing this. And interestingly, there actually was upward revisions to the previous 2 months. My hope is that they figured out whatever was causing the negative revision after negative revision and started to fix it. I'm not sure they have or not, but that's the type of thing they try to do. In terms of the number, yeah, it really changed the narrative that had been established 2 months ago when we saw the unemployment rate spike. There always was some temporary noise, temporary layoffs, hurricane, et cetera, going on then. And with 2 more months of data, the labor market looks, full speed ahead.
And is your sense that this changes the outlook for Jay Powell?
Oh, certainly. I mean, it went from, is it going to be 25 or 50 at the next meeting, to is he even going to cut rates at the next meeting? Inflation is still way below where it was a year or two ago. And so rates should be way below where they were a year or two ago. So I'd like to see him continue cutting, depending on what the data shows. But there's no reason at all that needs to be a rapid process, another 50.
Hey, Doug, if you were teaching an economics class, how would you grade this economy?
This economy is in very good shape in the near term, Andrew. There's no question about that. I think Friday's report was really good for the Fed. They had shifted the attention to the employment growth part of the mandate. That was a very strong report. It says that you don't have to worry as much about that as you might have thought, and they can continue to be looking at both the inflation and the employment mandate. I think it takes 50 basis points off the table, but I don't see them not cutting. They don't like to start and stop policy. So, I think they've signaled pretty clearly 25 basis points going forward. I was in the camp that thought they could do 25 to begin with. This just takes all the 50s off the table for the foreseeable future. And I think it puts a lot of pressure on the CPI report this week. I mean, they have made the case that inflation will return to the 2% target and remain there. And, core CPI is still anticipated to be 3.2 year over year, and getting it to 2 remains, in my view, an unfinished task. So they still have some work to do on the inflation front.
Jason, what do you think about the arguments that have been made? And these are political arguments, but maybe you'd argue they're economic arguments just about wages. That wages ultimately have not kept up with inflation, depending on what date you start at. Steve Leisman was here on Friday and used 2020 when the pandemic began as the date. Others have used when President Biden
he did pre-pandemic.
was named the president. He was doing it pre-pandemic.
2019.
Right.
Yeah. It's up since then, but it's down.
And how do you think that the American public should think about that?
Yeah, so I think the 3 facts that are correct are: number 1, wages are up faster than inflation. Number 2, a lot of those gains were in the year 2020. Number 3, even those gains are less than the normal pace. And I'll give you a bonus fact. Number 4, there are larger gains for workers who have lower wages than for workers who have higher wages. So there's been some compression of the wage distribution.
You're saying if you include the 2020 period?
If you include the 2020 period, yes, that last point included the 2020 period, which is when a lot of these real wage gains were. So, yeah, I think there's some reason for people to be a little bit disappointed with this economy. Growth is fantastic. Inflation is in the right direction. But people got themselves into a deep hole in 2022 and 2023. They're digging out of it with real wage gains now. But I think in some sense, they're not all the way out. And when I say not all the way out, that's relative to trend or expectations. They still are above inflation adjusted. So, I think for the Fed, that actually gives them more room to cut rates. It means some of the wage growth we're seeing is catch up with what happened before. So this is dovish information for the Fed. I don't think it fully explains how negative people have been about the economy. But it's a totally valid reason for people to be concerned.
Doug, you want to react to that?
Yeah, I think it's not too complicated. If you do it on political grading, you start in 2021 when President Biden took office. And, we had low unemployment through 21, 22, but negative real wage growth. So people went to work for 2 years and got further behind. And they didn't like it a bit. And now that reversed recently. But not everyone has climbed all the way out from that. And they're still upset about their standard of living growth during his tenure. And that's all there is to it.